Alright, ladies and gentlemen, we're going to do a quick Ichimoku study here. Let's get started. We're going to walk through here. This is our B4 algo, and this is our trading system. And we use Ichimoku. You can see it in our dashboard here. We have a grading system for our Ichimoku here that guides us through our trades. Of course, we have other things as well, mainly focusing on Ichimoku today. Let's talk about what makes up the Ichimoku trading system. It is a complete system. We utilize it in our trading strategy very heavily. Let's talk about the things that comprise the system. We have the Hane lines, which are these four lines here, the Cinco span B, the gold line there in the cloud, the Cinco span A, which is that white line in the cloud there, the Kijinsen, which is the gold line here, and the Tenkan-sen, which is that white line. Those are the four lines. They're called Hane lines. Hane meaning half price or mid price. Those are the some of the key lines in the Ichimoku trading system. This other line that we're looking at right there, that is called the Chikou, or the lagging line. Now, when Ichimoku was first started, there was only two lines that were used, and that was the Kijinsen and the Tenkan-sen. I'm not going to go into the mathematics behind everything here. You can look that up. There's resources everywhere on the internet about that. What we're going to focus on today is how I use it in my trading specifically. So here we are. We have a TK counter on our system. Basically, it's telling us how far back we had the TK cross. That's one of the trading signals in Ichimoku. Now, a lot of people are familiar with the 8-period moving average and the 20, and trade it as a crossover. Same principle applies here. However, these lines right here they're a good representation of the 8 and 20. Not exactly, but same principle applies. The good thing about this, it makes these lines what I think better than regular moving averages, is because they are Hane lines, half price. They form flat spots in them. These flat spots are significant areas of support and resistance. Okay. We can use these first two lines here of the cloud. These lines of the cloud, they are a representation of price in the future, a standard, if you will, of price in the future. It's not predicting the future, guys. It's basically just a standard for price in the future. And this represents the long-term trend, the Cinco span B. Then we have a midterm trend, and that would be your Kijinsen right here. And then a faster trend or shorter trend, that would be your Tenkan-sen, that white line right there. Now, if you're used to trading the 8 and 20 cross, you know that once they cross over, and your price gets above that 8, you stay with that trade until price closes below that 8. You do the same thing here with the Ichimoku, and using your Kijinsen, that gold line, as your stop loss. So let's kind of go through and look at that. You could enter the trade here, and let's walk it through. As long as that price doesn't close below that Tenkan-sen, which it hasn't there, you can stay with that trade. All right. Now, if you guys know how to use the B4, you know that a good place to exit with the B4 is whenever you lock in a dark curl, like in a bullish trade. That dark green curl there on the trend line, when it locks in, especially when it crosses over, it's time to exit your trade. And here we are with our Ichimoku there. Now, let's go over the lines a little bit. So we talked about the Hane lines. Talked about these right here. Now, these are shifted in the cloud. They're shifted 26 periods forward. This Chikou, which is not a Hane line, it is just price shifted back 26 periods. Now, there's a significance in that numbering system. 26 is half of 52. And how many weeks are there in a year? There's 52 weeks in a year, right? So what that is, that's a 52 is a complete cycle. And this is a half back here, halfway back. Now, the significance of doing that, you'll find that where these flat spots happen on the cloud and on the our Kijinsen and Tenkan-sen, those flat spots are significant areas of support and resistance. And so you can see that Chikou come in and it'll honor that and respect that. So you'll know when there's still existing resting orders that can supply and demand zones. Our support and resistance levels signifies those very well. And because it's shifted back 26 periods, it gives you a good, a taste of that, and you know when it respects those lines, when it bounces off those lines, finds support on those lines, you realize it's because there's still existing orders there. So we can look right here. We can see the Chikou coming down. Where did it come down to? It came down to the bottom of the cloud here. Found support and bounced off. Now, one thing about Ichimoku is it's Ichimoku Kinko Hyo. Basically, it means equilibrium at a glance. Why is it important to spot equilibrium? Well, because you don't want to be caught up in equilibrium. You're caught up in the chop. And any money manager knows that you want to be able to identify chop so you can stay out of that. You want to be either trading here or trading to the bearish side in an unbalanced state. You don't want to be in a balanced state or equilibrium trading. All right. So you can see right here. So here's a good exit. We already called it out. But we use the Chikou too. Let's keep walking this trade forward. Let me show you a little something. Notice the Chikou starts getting closer to the price. So what I do is whenever we first break out above the cloud and above price with the Chikou, I pull a line on that from there to there. It's kind of a measuring rod. And I keep that going with me, and I keep that like pulling up to the low spots here, pulling to the low spots. I use it as a gauge for overbought or oversold. And when I get about 1/3 in on this line, I know, hey, I'm overbought at this position. And I know it's time for me to consider exiting that trade. Let's just walk it through some more. One principle I do too is when that Chikou, if I didn't exit there and I for some reason stayed in that trade, When that cheek out comes in and touches the price, that's usually a good exit point for me. Now, while we're right here, let me talk about something. Let's talk about this cloud, the Kumo. A lot of people call it a Kumo cloud. Guys, it's not a Kumo cloud. Kumo means cloud. It's not a Kumo Kumo. It's a Kumo. You notice how it's thick right here? The cloud, usually there's a good support and resistance or resistance level there in the middle of the cloud. The thicker the cloud, the harder it is for price to come through. Now there's different strategies. There's any edge you can find in the market. You could turn it around and produce a trading strategy from it. One of the things that that's noticed is if the price comes in and closes one candle inside of the Kumo, that's called an edge-to-edge trading strategy. Some people trade it all the way through, thinking it's going to go all the way through the cloud there. Price would come all the way through the cloud. I don't find as much success with that strategy. I typically stay out of trades when it's in the cloud. It's kind of like this. Let's just consider price, these candles being an airplane. You would want to fly above the cloud or below the cloud. You would not want to fly in the cloud because you would find in-flight turbulence there. So just think of it like that. That's kind of how I think of it. Try to keep things simple. While we're talking about the cloud, let's talk about these lines, how they form a little bit here. Notice it looks kind of like a fish there. When you eat fish, you don't want to eat part of the tail, and you don't want to eat the head. The best part of the fish is right there in the meat of the body of the fish, right? That's where you're fed from. So every Kumo has a head and a tail. Now, the way that you can distinguish the head and the tail is once we start, notice right here where you got the twist happening, very volatile. Notice how the lines are paired and they're moving up. That's a very volatile area. Well, that could turn around and slap on you. It's like grabbing a fish by the tail. You grab that fish by the tail, try to pick it up, that thing could flip out and slip out of your hands and make a mess of you. And that's how it navigates and pushes itself through the water, right? Same thing with this trade. That right there is a risky part of the trade. Yes, it moved nice, and that's a nice institutional push there. That's great. However, I might want to wait and get into the body of the fish. So how do you find the body? Well, after the first part where it starts flattening out, and you see the Cinco span B flattening out there, that's where your body starts. So that's where you want to be in the trade. And then when you want to be out of you don't want to be in the head. Well, where does the head start? That's the hardest part for me to find. The way that I do that is if I notice that my cheek out's coming in and coming into price, and I notice it starts forming like this, kind of like a C-clamp right there, I'll call that the head of the trade there, the head of the fish. Let's keep on rolling it through here. Now we see it starting to cross over here. While we're looking at this, let me show you a little something with our B4. Note, and of course the B4 indicator is free. Notice how we started here with the B4. We have the buy signal. This is our B4 algo, and this is part of our trade strategy that we have here with our entire system. But notice the momentum that you have here. Nice, a nice momentum there. Notice that here it stops. Momentum stops in the trade, according to the B4. Now we're moving down on the back side of that momentum right here with the B4. you've lost momentum here. All right, let me show you a few little things about Ichimoku that you may not have known. These lines right here, the T and the K, Tinkinson and the Kijinson, I find them far superior than any moving average you could put on your chart, whether it's EMA or a whole moving average or any of these super fast moving averages, whatever. I find these two lines a lot more valuable. Why is that? Why would I say that? Notice where these lines flatten out. These flat spots are key levels. Notice what happens when it flattens out too. Let's just take price is moving below it and it flattens, right? What does price do? It pauses out and it retraces back to it. Well, does that happen in the bullish positions too? Let's take a look. Kijinson flattens out. What does price do? Retraces. Kijinson flattens out. What does price do? Retraces. Kijinson starts flattening. What does price do? Retrace. Let's go through and look at a few more instances. Let's just go right here, for instance. Kijinson's flattening. What does price do? Kijinson's flattening. What does price do? Now it pauses out here. Let's look at some other instances. And I'm just going through. Here, we'll look anywhere. Price is moving down, right? Kijinson flattens. What does price do? Starts moving down, right? Kijinson flattens. What does price do? Moving down again, flattens out. What does price do?